Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Scott Martin, who is the Chief Market Strategist at United Advisors. Scott, thanks for being here.
And a Fox Business Contributor.
Fox Business Contributor.
Get all the legalities out.
All right, it's out there now. So I'd like to talk to you about your outlook for this year. A lot of things going on. Obviously, we have perhaps austerity coming to the United States, the sequester, and continued austerity in Europe. We recently saw a negative read on U.S. GDP for the fourth quarter. What are you telling your clients right now?
You just scared me, by the way, okay? Here's what I think is good.
Here's
what I think is good about, yeah, right, where was I? Here's what I think is good about what you just said. There is this wall of worry that is probably taller than it's ever been, right? Because things aren't improving in Europe. You're right. In fact, they're getting worse. Things aren't great in the United States. Negative GDP report recently. But yet the market, Mike, I think is going to continue to go up this wall of worry. Because again, if you look around the globe and look where interest rates are, look at the 10-year, 2%, corporate bond rates. People aren't talking about this. Corporate bond rates are getting smashed, man, because bonds are going up. You know, rates, bonds are getting sold. Nobody's buying them. They're going to equities because they need return.
So we see a rotation, you're saying, out of bonds and into equities. Is it purely based on, seeking return, or is it based on a better outlook, people feeling more confident? I mean, notwithstanding the things I just said, there are a lot of people now. I mean, I read something recently about one very big hedge fund guy who's saying that he's looking for an explosion of greatness in the United States this year. So there's suddenly also sort of a newfound bullish attitude, isn't there?
Yeah, and that could have been Ryan Gosling that said that. That guy, whatever he says is gold, right? But you're right.
It was actually David Tepper.
There you go. Okay, same difference. But you know what I mean? Like, they're a little different. There is certainly, Mike, I think the issue of safety of return, maybe to your question, right? Like, if you were out there buying a U.S. Treasury bond right now, you're lending the government, the U.S. government, that's practically in default, right? That's bankrupt.
Well, it can't be in default.
But of course, we can always do that. We're always going to pay our bills. We can add zeros to the balance sheets. That's right. But you get my point. You're risking an asset in bonds, a 10-year government note at 2%. They're going to pay you 2% per year. I think people look at stocks and say, hey, these companies are still making record profit numbers. Yes, they're shrinking. The profit growth isn't what it was. But they say, you know what? We're a little bit more comfortable with our money there than it is in the hands of the U.S. government.
All right. So when you're talking about risk assets, you mentioned, you're talking about equities versus bonds. How about within the realm of risk assets? What about hard assets? What about commodities? How does that stack up?
It's a great question. And I'll tell you one weird thing that's been going on in gold particularly. I watch gold a lot. I own gold in my portfolio for my clients. IAU is one of the ways you can do it. It's an ETF. Gold has been basically a Lindsay Lohan market over the last 6 months. What does that mean? One good month, one bad month. One good month, one bad month, just like Lindsay Lohan has, right? That's weird to me, though. That's a strange thing, though, Mike, because that makes gold a tough asset here. Why? Because it's not behaving like anything. Like, you can't track the correlation of it versus the S&P or versus bonds. So to me, that's a tough spot for me with regards to gold, because I want to own something that I understand and know how it's going to move versus the equity markets. Right now, it's not doing that.
But doesn't that portend a move away from that static environment? Or are you saying it's just going to, now it's stuck in that range and it's going to trade like that or behave like that for the long term? And how do you know?
You don't know, but I'll tell you one weird thing that's been going on. Remember the very tepid, very inconsequential, let's say, Bank of Japan that came out with this billion-dollar stimulus, multi-billion-dollar stimulus at the end of last year, which was unheard of for the Bank of Japan. Crush the yen. They want to get exports up, that sort of thing. There is a massive liquidity surge in the globe right now. Gold's not going up. And you're right, on a technical basis, if you look at the charts over a 5-year, it looks toppy. So I think gold is something that you have to watch closely if you own it. I still own it, but I'm saying, gosh, I wish it would start acting like something. But I also realize, look, other metals are not behaving well either. Copper, which to me is a leading indicator of the economy, certainly copper's in a lot of things, not doing great over the last few months.
What about something like oil, where we've seen oil prices gravitate back up? We're just shy of $100 on WTI, higher obviously on the Brent. How does that look?
That's the story behind the story to me. I think that's a great point. How in an environment where global growth is slowing. Now, who do you believe? Do you believe the IMF? Do you believe the World Bank as far as their outlooks for global growth? Probably not, but the trend is not favorable, right? They keep ratcheting it down. Yet, oil prices are going up.
Yeah.
That's a weird thing, and that's exactly a great question, because that's the story behind the story to me, because we all know when oil prices go up, that's not necessarily good for business. It's not good for transportation of goods. That's the kind of thing that can put the brakes on this economy, in my opinion.
Yeah, and it's not good for consumption. I mean, it's actually taking money out of people's disposable spending.
And go back to the government issue, right? A lot of taxes are in gasoline right now, right? I'm from Illinois. I'm in Chicago. There's talk about new gas taxes in our great, terrible state of Illinois, which just got downgraded recently because they need to fix the budget deficit. So you're telling me gas is going to go up even further when people are pinched.
So what areas should investors be focusing on? Obviously, you're saying take on risk, but in what areas?
Here's the thing. I like overseas markets right now. Why? Because they're delivering beta. And what do I mean by beta? I mean a little bit more upside when the market goes up, in the sense that if you look at the S&P and you look at emerging markets, if you look at the Far East markets, Mike, they tend to go up more when the S&P goes up in a factor of maybe 1.1 to 1.2. I like the emerging markets in those overseas areas, especially as we approach new fiscal cliffs, sequestration, more austerity, all the things you scared me about 7 minutes ago. That's where I like my odds. I like them overseas.
So are you talking about China? Are you talking about Taiwan, South Korea?
Absolutely. Fringe
Singapore?
Markets. Absolutely. Singapore. You have to look around China nowadays, too. Korea is a great market. Even Japan. I actually think this devaluation of the yen, the sleepy Japanese economy, might wake up. And I'll tell you.
But is it going to last? I mean, they haven't really done anything. All this has been jawboning. It's been talk. I mean, there's nothing that has been done. Can this be sustained?
It probably can't be.
In fact, if you look at it, it's been mostly small speculators, or speculators, I should say, selling the yen.
That's true, but I will tell you, a 10% move in a currency over this period is huge.
Yeah.
And it will have an impact in some way, shape, or form. But you're right. The investing climate, as we know, is very different now. I always say, what's your long term these days? Maybe 6 months? Things could definitely change, you're right, but I think for the short term, which is maybe a month, and the long term, which is 6 months, I think you have a window there to go overseas.
Okay, so bottom line, take on risk, Far East markets, Asian markets, all those things look good. Maybe stay away from gold.
Yes, and low interest rates are great for the stock market, and they're going to stay low.
They are going to stay low. Yep. I agree with you on that. Scott Martin, great to have you.
Good to see you.
You too. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.